Most people think they're investing safely, but they're actually throwing money away. In this video, I'll break down the mistakes that are quietly draining your wealth. Why no investment is truly risk. Many people hear phrases like safe investment or guaranteed profit and assume that some investments have zero risk. In reality, risk can be reduced, managed, or transferred, but it can never be completely eliminated. Every investment exists inside an economic system that constantly changes. Let's break this down clearly. Risk is inherent to the meaning of investing. Investment means putting money into something today with the expectation of getting more money back in the future. That time gap automatically creates risk because the future is uncertain. Conditions can change. Outcomes are not guaranteed. If there were truly zero risk, it wouldn't be an investment. It would simply be money storage, like keeping cash in your pocket. Inflation risk, the silent loss most people ignore. Even if your money never decreases in number, it can lose value in purchasing power. Even if your money never decreases in number, it can lose value in purchasing power. Example, you invest 1 million Nigerian Nairas. You get back 1 million Nigerian Nairas after 1 year. Inflation is 20%. You did not lose money numerically, but you lost buying power. That is still risk. This means even safe investments that preserve capital are not risk-free because inflation slowly erodes value. Government-backed instruments are not truly risk-free. People often say, government bonds are risk-free. They are low risk, not no risk. Why? Governments can default. History proves this. Governments can print money, reducing currency value. Governments can change policies or tax returns. Currency devaluation can destroy returns for foreign investors. So even the safest assets carry default risk, inflation risk, currency risk. Market risk. Prices move beyond human control. Markets are influenced by interest rates, politics, wars, pandemics, technology changes, investor psychology. No investor controls these forces. Even blue-chip stocks can drop sharply, can underperform for years, can become irrelevant. Think of once great companies that collapsed. If price movement exists, risk exists. Business risk. Companies can fail. When you invest in stocks, private businesses, crypto projects, startups, you are exposed to business risk, including poor management, fraud, competition, regulation, changing consumer behavior. Even profitable companies can fail due to unexpected events. Liquidity risk. You may not access your money when needed. An investment might look safe until you need your money urgently. Examples: real estate takes time to sell. Fixed deposits penalize early withdrawal. Some funds lock your money for years. If you cannot convert your investment to cash at the right time, that is risk. Interest rate risk. Changing rates affect value. When interest rates rise, bond prices fall. Stock valuations drop. Borrowing becomes expensive. Asset prices decline. When interest rates fall, cash yields lose value. You cannot escape interest rate risk. You can only choose which side you're on. Currency risk. Money can lose value without warning. If you invest in foreign assets, local assets in a weakening currency, your returns can be wiped out by devaluation, exchange rate controls, inflation spikes. This is especially important in developing economies. Psychological and human risk. Humans make decisions, and humans are imperfect. Risks include panic selling, greed buying, overconfidence, herd mentality. Even the best investment can fail in the hands of the wrong behavior. Regulatory and legal risk. Governments can ban industries, change tax laws, freeze accounts, introduce new regulations. What is legal and profitable today may be restricted tomorrow. Even insurance does not remove risk completely. People say, this investment is insured. Insurance has limits, has conditions, can fail, can be delayed. Insurance reduces loss. It does not erase risk. If zero risk truly existed, everyone would use it. If an investment had zero risk, high returns, guaranteed payout, then banks would use it, governments would use it, billionaires would use it, everyone would abandon other investments. The fact that different investments still exist proves that trade-offs are unavoidable. Risk and return are linked by natural law. This is one of the most important truths in finance. Higher potential return always comes with higher risk. If someone promises high returns, no risk, guaranteed income, They are either lying, misunderstanding finance, running a scam, hiding the risk. What low risk actually means, important clarification. Low risk does not mean no risk, guaranteed profit, loss impossible. Low risk means lower chance of loss, lower volatility, lower expected return. Risk is reduced, not removed. Final truth, there is no such thing as a risk-free investment. There are only known risks, unknown risks, managed risks, hidden risks. Anyone who claims otherwise is either uninformed or dishonest. Don't forget to hit the subscribe button and engage my videos.